Welcome to my channel. The channel motivates students and researchers to polish their economic skills with a classroom PowerPoint presentation to understand the topic. Today we will discuss flexible exchange rate system. Most countries allow their currency to fluctuate freely, with occasional government interference to stabilize the exchange rate to help international trade. The interference is more prominent in developing countries as they like to cover their trade deficit without devaluating their currency value. The responsibility to manage countries' foreign exchange and the foreign exchange rate is with each nation's central bank. In the flexible exchange system, as every currency fluctuates in value in terms of others, it is necessary to determine the exchange rate based on its intrinsic value in international business transactions. It is based on the demand and supply of different currencies in an international foreign exchange market. Virtues of flexible exchange rate system. 1. There is no need for gold reserves. It doesn't need gold reserves as currencies are based on demand and supply in the exchange market and don't need to be converted into gold. 2. It provides capital mobility, as countries do not need to cover themselves with gold or gold-based currency. The capital is free for investment opportunities available in different nations. 3. Venture capital is encouraged. It boosts speculative opportunities in international trade, and venture capitalists takes advantage of it and promote the exchange market. 4. Resources allocation is at the optimum level, as supply and demand are the basis of the determination of exchange rate. It promotes optimum resource allocation for a nation. Shortcomings of flexible exchange rate system. 1. Instability in the exchange market. Speculators keep the market volatile while traders feel burnt as they often expose themselves and face adverse exchange rates for their import-exports. 2. Fluctuation in the exchange rate made long-term policy determination difficult. It is difficult to form any policy when exchange rates are volatile. 3. Face difficulties in bilateral trade. Fluctuation in currency make it difficult for two parties to agree on bilateral trade as currency rates may move either way, leading to a loss in trade for parties. Other systems of the exchange rate. Hybrid system. 1. Wider bands. The system allows 10% movement in currency in both directions, up and down. According to the balance of payment situation, a country's central bank will allow the movement of its currency within the band value or between the two extreme points. 2. Crawling peg. These are the regular adjustments but are of a very small nature, not more than plus or minus 1%. Under the system, currency movements are kept in a narrow band. 3. Managed floating. The currency adjustments as per the currency exchange market's pre-decided official rules and regulations. There is no range in which currency movement is controlled, but the regulatory authorities allowed adjustment based on the needs of the country. 4. Dirty floating. It is the exercise by a country to manage its currency rates without observing rules and regulations, and it indicates manipulation of its currency so that it became the reason for other countries' loss. I hope the discussion is helpful. Don't forget to subscribe and stay connected for future discussions.